my name is Will Dougal, an associate within the Pengana distribution team based here in Sydney. Thank you for joining today's webinar, where we'll be providing an update on the Pengana Axiom International Funds. The two funds follow the same underlying strategy, with the key distinction being that one is currency hedged, while the other is not. We're pleased to have Bradley Moles, Managing Director and Lead Portfolio Manager, and David Schneider, Senior Research Analyst, presenting for us today. I'm actually quite excited to facilitate today's webinar as the fund has delivered sensational performance over the past year, achieving a net return of 27.3% for the 12 months ending 30 September. Bradley and David will provide insights into their dynamic growth investment approach and highlight some of the compelling opportunities they are seeing in global equities today. The presentation will run for approximately 25 minutes, followed by a Q&A session. So please feel free to submit your questions throughout the presentation using the Q&A icon at the bottom of your screen. And with that, I'll hand it over to you, Bradley.
So welcome to the Axiom Investors presentation. I'll really begin with a high-level overview of our firm. So Axiom was founded by my partner, Andrew Jacobson, 25 years ago. We're focused on growth investing, and we're a centralized organization just based outside of New York in Greenwich, Connecticut. Our assets, we manage just over $23 billion under management, and it's a very closely knit team. The entire firm is about 60 people. The investment team is about half of the employees. Our philosophy is very holistic, very consistent, and is a deeply fundamental bottom-up process that is proven throughout market cycles. Andrew and I have been together for nearly 25 years. We've both been navigating the growth equity markets for 3+ decades. And so you have a very seasoned, solid team that have worked together and communicated and understood these markets, both macro and micro, for a long period. Importantly, as you can see, our team as well are very experienced. And then most importantly, we have a very aligned culture. We all invest significantly alongside our clients. We have a 100% employee-owned culture where there are 28 equity partners, certainly all of the investment folks, the portfolio managers, and many people in client service and operations are all aligned with people like yourselves, our trusted and key investors. In terms of what we do, we really have one alpha philosophy. So unlike many other organizations where different folks are pulling in different directions, Axiom is clearly focused on one set of alpha drivers, which helps us generate 2 to 4% of outperformance. Clearly, over the last year or two, we've had very good performance, but we're able to navigate. And this philosophy is actually just passing its 2-decade anniversary as of this month. And importantly, the tenets, the pillars of our philosophy are 3 broad categories you can see listed there. The largest one, positive change. So we're really deeply focused on companies that are changing and improving for the better. And that really is a very holistic approach. It consistently incorporates both macro and micro and is very facts and evidence-based. Overlaid on that is an approach where we are able to own many of these growth companies for long duration. So we're looking for companies where there are high moats, where the tailwinds for performance, both macro, micro, and in terms of ESG, allow these companies to outperform at a higher cadence and most importantly for a very long period. And we're able to reappraise, reassess. Our investment process is very circular. It doesn't have an A and a Z, a beginning and an end. It's very iterative. As I said, it's based on the facts and evidence. And then finally, our valuation is comprehensively interwoven into our philosophy and is something that is continually updated and allows us to own many of these businesses for, sometimes up to a decade, return to them when things change. But most importantly, we continuously re-underwriting the positive change, the sustainability, and the valuation in order to be sure that we have around 4 dozen odd stocks in this implementation that are the most optimized in terms of both the capital allocation and whether that's the sizing, and then whether they're good enough to be included in the philosophy. I'm going to move on together with Dave to three case studies that really take you through how we think and how we embrace this positive change and this very successful approach, and together with Pengana. The first case study really talks to something that's very timely. It's obviously been in all the press articles, and it really focuses on AI. Clearly, we all know and have read a lot about AI, and it's something that we think we're really in the early innings of. And importantly, for the facts and the evidence really collaborate that. So when we take a look, this is just a snapshot of the global server environment, approximately 12 million servers around the world. And as we stand today, really the key thing is that this is very nascent. We're at a very small single-digit percentage, somewhere around 4% of servers. NVIDIA is going to sell about 450,000 servers that will be AI-enabled this year. And you can see that's a small fraction of the 12 million servers. And the green bar really represents these AI servers. You can see the uptake is moving up fast. But importantly, we're really tracking data that Dave's going to talk to you about in a moment, whether it's the amount of flops or some key data that he's going to show you on wafers that are tracking materially ahead. These things are growing 30-40% sequentially, and that's way higher than is embedded in investors' expectations. I'm going to pause now and let Dave take you through this and some other tech ideas that we've monitored, and how we respond to the facts, and how that is incorporated into our portfolio allocation and risk management.
So as Bradley was discussing in the investment approach slide, the 100% of what we do is analyzing companies with a focus on the forward operating metrics and how that data tracks over time. And then we build our forecasts for our models out into the future to the greatest extent where the data is available to support that. So in this instance here, what we're showing you is we use a third-party data provider that provides us with wafer level procurement data at TSMC, which is NVIDIA's foundry. So NVIDIA designed chips, TSMC is making the chips. And what we do is we track this data, talk to many industry participants, determine elements like yields, breakdown between chips, cycle times of various chips, by nanometer, which is the transistor width in between the copper lines, if you will. And what we do is we take this bottoms up data, and we build forecasts of which will eventually come to NVIDIA's revenue forecast. So what we know is that, here's the historic trend you'll see here in these the blue lines. And then we have the 3 upcoming quarters forecasts. And we delineate our forecast based on if a chip goes into the foundry this quarter, all else equal, it creates revenue next quarter. It takes about 3 to 4 months to make a chip, including all the front end lithography, all the etching and deposition steps, and then into the packaging, where it comes out in the baseboard that you might have seen in various press articles. So what we do is this data provider gives us about 2 forward quarters of procurement data, and we use that data to track 3 quarters in advance of chip data. So as you can see here, as we get this data in real time, we're constantly adjusting our models, making sure that we're trying to be as ahead of the curve as possible. And what this shows us is that as we get into the first quarter of next year, the gap or the potential for positive change, which is 60% of our investment philosophy, is actually growing relative to consensus expectations for NVIDIA. So despite what has been dramatic outperformance of the security, very significant capital appreciation, it's a unique scenario whereby as we sit here today, looking forward, not looking backwards, looking forwards, we actually have a wider gap to consensus expectations than frankly we did when we initiated the position over 18 months ago. So as we sit here today, NVIDIA remains very well positioned in the generative AI infrastructure market, both from a market share and a moat perspective. And we do several other analyses on the side, but this is the primary one that drives our bottoms up forecasting. So we wanted to share it with you today. And what this slide indicates is on the left-hand side here, we have a internal database that is filled with millions and millions of data points that we as analysts and portfolio managers rank on a daily basis. And what you'll see here is we're superimposing some of these data points that we've put into our system in the share price. So as what you'll see way back in 2022, we started to notice NVIDIA's fundamentals improving on the margin, right? A positive inflection or a positive change, as we like to call it. And then as we progressed through the end of 2022, we saw sales at its main foundry partner, TSMC, starting to improve. And then that drove us to start the position in mid-December of 2022. And then as we continue to build the position, as we continue to track the data continued to get better and better. And over this time, as the data continues to drive our decision making, we continue to size up to the position that it is today. And as you can see by the chart, it's obviously proven to be quite good performer over the last 18 months. Now, the next slide, if you could, ASML is another example of a company with a very good positioning strategically from a long-term perspective, but the benefits of generative AI from an infrastructure perspective are not accruing to ASML in real time. ASML has been a long-standing position of the fund. I bet we've owned it for 5 or 6 years. But what happened at the end of the summer of 2024 was that several of ASML's biggest customers, primarily Intel and Samsung, are not benefiting from the build out that we're seeing in generative AI infrastructure. So what happened in August of 2024 was Intel cut CapEx. Intel is one of the largest customers of ASML. So we took that as a sign that there could be a potential order issue at ASML. And then a month later, we saw its customer, Samsung, arguably its second biggest customer behind TSMC, also have some yield issues at a new plant they were building in Texas, in the United States. So 2 points make a line, and it drives our decision making. So we took that as a signal that we should be trimming our position in ASML. So the reason for adding ASML on the back of what was obviously very positive data points from NVIDIA is just to show to you guys as investors that we don't just buy stocks and monitor the data. We monitor the data and we act where appropriate, and data drives our decision making. So in this case, it drove our decision making to start NVIDIA in early or late 2022 and build a position aggressively in early 2023. And for ASML, it drove our decision making to trim the position over the summer of 2024 into the fall. And with that, I'll pass on to Bradley for case study number 2 on the diabetes and GLP-1 market. Thanks.
Thanks, Dave. And so, yes, we're going to transition and really try and illustrate to you how we both address the facts and evidence, like David discussed in the prior slides, and the market opportunity, the sustainability relative to current expectations, with the view looking out 3 to 6 quarters, which is the sweet spot where we were able to significantly have a delta versus, in many cases, dozens of analysts that are covering stocks. So if we take a look at the diabetes drugs, these are stocks that we've owned from late 2021 and into 2022 when we began our second position, which was Lilly. We began with Novo Nordisk. And importantly, when we looked at this market, we saw how enormous, sadly, the obesity market is. So you can see here 100 million people in the US alone, over 40% of the population obese, with nearly 10% very obese, they're called morbidly obese, which means that the potential TAM, or the potential market, at about $6,000 a month is $600 billion. obviously an enormous market. Moving forward, we were able to track via our healthcare team the prescription trends. These are each month a person gets signed up for 4 weeks of the drugs. You can see it began at the bottom with the first one being Ozempic. We moved on to drugs that have all become household names: Wegovy, Trulicity, then Zepbound. And in aggregate, you can see the gray line that tracks the overall scripts, which are running now at 1.6 million a week, which rounds out to about 6 million people. So only really 1% of that crazy 600 million market only 1% of the 600 billion market right now, but clearly growing very fast. And that really is the facts and evidence that have allowed us to monitor, allowed us to begin having this dynamic gap, which you can see on the next slide, where our forecasts were meaningfully ahead of consensus. There was a time that our forecasts for next year were 70 billion and the consensus was 35. You can see that's clearly narrowed, and the dark blue and our light blue line have begun to converge. Certainly for this year, they're very close. And then the upside that was 50+% for next year have really moderated. And that's meant that both of these positions, which were really meaningful positions in the portfolios, both Novo Nordisk and eventually Eli Lilly, have been meaningfully moderated. And if you take a look on the next slide, you can see that the Eli Lilly stock has performed exceedingly well, but we've begun to trim the stock throughout the summer, both Novo and Lilly, and our positions are now meaningfully smaller than they were a year ago. And there again, to emphasize, we don't stand still. Our process is iterative. We keep reappraising and, in our lingo, recalibrating the risk and the return score, both a number and a letter ranking. And in the case of these stocks, they've moderated. The stock positions have moved up, and that's meant that the position sizes are meaningfully smaller than they were a year ago. And then finally, to change the flavor a little bit, I thought we'd do one final case study that probably familiar to you folks in Australia, and this is Chipotle Mexican Grill, or CMG as we call it. And interestingly, that company has a copycat in Australia called Guzman and Gomez. And really for us, this is the name that we initiated during the summer, where there was a price opportunity, as you can see illustrated by the share chart on the right. It was a name that in our lingo was a B, but it transiently moved up from sort of a B 1.1, 1.2 to nearly a B 1.5. The dynamism became not fully embedded in the share price. As you can see, the share price had a meaningful drawdown as there were concerns about a social media set of publicity around their portion size. However, the real-time data on traffic and credit cards was actually accelerating. So that really caused us to initiate a position. They also were adding to their menu by bringing in things like new types of chicken and a brisket offering. And we commenced the position size in late July of this year. After that, there was very well publicized news events where the CEO of Chipotle was recruited to try and fix a problem situation at Starbucks. And that also caused some volatility in the share price. But we remained steadfast, and the data began to build the position, take this opportunity to really rely that the management, a gentleman, Scott, who is now running the company, had all the skill set to continue to grow the CMG brand. And this became a more meaningful position in the Axiom Pengana portfolios. And then finally, just to contrast it so that you folks can see, this gives you some metrics. So Chipotle is about 3,500 stores. That compares to about 2,000 for Guzman and Gomez. Most importantly, it's a way better business in terms of the way we rank the return parameters. So way higher returns on capital, way lower valuations, way less leverage. And most importantly, the restaurant margins continue to be at way more lofty levels. And finally, just to leave you with, we view the data and the opportunity for them to extend their menu, move into things like breakfasts and other areas that Chipotle have not embraced as sort of the runway for not only more dynamic environment right now, but a meaningfully more sustainable environment than many other both buy side and sell side folks either owning or forecasting for the stock are not embedded in their expectations. And so that really means that the stock ranks up for us in our parlance as a very solid B1, as I said, sort of about a B1.4, so almost a B2, and is a very attractive risk return and a new name that we've added to the portfolios in the last couple months. I'm going to pause there and hand you back to Will, who I think will curate and open the floor to questions.
Brilliant. Thank you, Bradley and David, for the insightful update. Now, we've already received several questions, but just a reminder that there is still time to submit any additional questions using the Q&A box just at the bottom of your screen. So the first question we've got here, could you elaborate on how you identify structural growth trends in the market?
Sure, I'll begin and then I'll let Dave also answer. Again, for us, the key thing is the PMs and the analysts are at the coalface. We are looking for these nuggets of information. We're clearly in a world where the challenge is to find the signal from the noise. Importantly, at Axiom, we have this great tool called Axware, where each of the analysts curates and scores data points, be they a new product introduction, a same-store sales, a price change, and importantly, they appraise it with the depth and understanding of their multi-decade knowledge of the sectors of, in many cases, the actual company, and are able to incorporate this into a score being neutral, very positive, or marginally positive, or conversely on the negative side. And that is really the synthesis, the genesis of how we both find ideas and then importantly, put together a deep and detailed understanding of the corporations.
Yeah, and the only thing I would add would just be underscoring the tenure of not just the portfolio managers, but the analyst team here. And, that's not by, happenstance. We're treated as our voice is listened to as almost sector portfolio managers and upwards of, 20, 25 years of experience. So, every day we're looking at the incoming, data on our areas of expertise, ranking data in our Axware system, making decisions, based on that, and really understanding the trends in our respective industries and how to best position the fund to take advantage of those.
Right. We've got another one here. It feels like we're facing peak uncertainty with factors like US election, geopolitical tensions, and rapid tech changes all converging. How do you navigate and integrate this level of uncertainty into your stock picking process?
Yeah, great question. I would bring it down to sort of two key pillars. The one would be the process and how holistic and repeatable our process is. And then the second component would be what Dave just spoke about, the tenure, the experience of the entire team in navigating through market cycles. And importantly, I would really leave you with, if you have this process and this experience, you're able to look through the noise, you're able to look through the uncertainty and have a lens as to where things are going to be in the medium term, a couple of months and a couple of quarters out, Clearly, markets tend to oscillate. They tend to move around. Markets hate surprise. They tend to take a position on a topic, macro, inflation, growth, an outcome of a hopefully binary event like the election with a clear decision in 2+ weeks' time. But what they tend to do is they tend to be very volatile around surprises and around uncertainty. But that tends to be a transient event. And so long as one can be beholden to the data and to the process, it allows one over the balance of time to have an excellent batting average and really navigate through the noise and focus on the signal with a more medium-term horizon.
Yeah, and again, just to underscore, we don't make 10-year forecasts. We typically model our companies from a bottoms-up perspective over a 1 to 2 year time horizon. And I think one other thing that really separates us, as analysts and portfolio managers, we spend quite a bit of our time monitoring the existing holdings in the fund for incoming data and sizing the positions, reacting to the data if deemed appropriate. So, we don't just buy stocks on an initial thesis and in hope over a 10-year horizon that they compound at an above market rate of return. We're constantly monitoring, constantly adjusting when needed.
Absolutely. And just another question on NVIDIA, obviously spoke about it earlier, but how high do you think that share price can go, and which other companies do you see sort of benefiting alongside it?
Sure. Yeah. The share price is tough because, we also don't come up with firm price targets that mandate us to sell when a given price target is reached, because the process is iterative and because the process is in real time. As the incoming data influences our estimates, we change our price target. When it comes to other beneficiaries of AI, another very significant holding in the fund is NVIDIA's foundry partner that I spoke to, TSMC. They're, because of those problems that caused us to trim the position in ASML at Intel and Samsung, TSMC is really distancing themselves as a leading edge foundry, really becoming a single source supplier to the world's leading chip designers. So, a lot of people focus on NVIDIA, but Apple's actually TSMC's largest customer, right? And Apple volumes from an iPhone perspective are not particularly strong growing, but expectations at Apple are pretty reasonable. And so we look at how trends are going at Apple. We look at other major customers like Qualcomm and AMD for TSMC as well. And what we're seeing is that generally AI-driven semiconductor demand is quite insatiable, as Jensen would say, insane. But outside of that, we don't have a lot of other semiconductor exposure because, the traditional semiconductor end markets, like smartphones and PCs, are not really experiencing strong growth or any growth at all, for that matter. Primarily a function of just maturity and saturation in those end markets. They become replacement markets in many respects, and particularly at the edge, as people like to call it. They have yet to experience any demand improvement from generative AI. We do think that generative AI applications will eventually move to our pockets in our laptops, but that's still early, in the vast majority of that work is getting done in the cloud today.
Yeah, I think, Dave, that's a great answer. I would just add one thing. Axiom is an all-cap firm. We have our partners and our colleagues that focus on small and mid-cap names. And many of those names actually provide key data for many of the companies that are, the superstars in the space, be it NVIDIA and TSMC. But in addition, we're able to move into niche companies. And in the case of AI, over the last couple of quarters, we established a position in Invertive, which is a partner with many of these server and data center manufacturers in providing a technology to cool these AI chips, which produce disproportionate amount of heat disproportionate amount of kilowatts of power are consumed. And Vertiv is very focused on creating elegant solutions to cool these in an efficient way, including liquid cooling. And that's a nice example of how in these portfolios, we're able to obviously own the mega cap names that David spoke of, but also own in a more moderate position, what we would call a niche company like Vertiv, where they own a space, they can add alpha, they add active share to our portfolios, but they are really different and have different risk characteristics and provide opportunities for us to add value for our customers, like the folks at Pengana.
Brilliant. Thanks, Bradley. And just switching to sort of macro level, while many investors are assuming interest rates are on a downward trajectory from here, what if that assumption proves to be incorrect, and how would you adjust the investment strategy in such a scenario?
Sure. So first of all, we do not make forecasts. We really track the macroeconomic data for all the developed and emerging countries around the world, nearly 100 countries, and we bucket it into growth, inflation, and balance sheet. And we, as many of the folks from Pengana have seen, we address this at each of our monthly update calls. And the data right now is pretty strongly showing evidence that growth continues to be moderate to stagnant. On the other hand, inflation continues to be declining and not showing signs of any propensity to begin to spike up. And that really gets incorporated into our stock selection, into our portfolio construction, but it's something that we're not wedded to our current view. We'll let the data and the information flow, particularly with regard to how that compares and calibrates to the economists and the forecasters' expectations, and make adjustments accordingly. Right now, we're not feeling that's a problem, but we're cognizant that our view can change, and that the outcomes of things like the election can potentially put us in a more of an environment where there's a propensity to spend, and where the effects and the completeness of the Fed's monetary policy to alleviate inflation may become negated.
Okay, thank you, Bradley. And just, I think we've got time for one last one, and just on China. So with China's recent massive rebound, where are you finding investment opportunities at the moment?
Sure, Dave. I'll start and then you can wrap up. Broadly speaking, we're really not exposed to China. We have exposure through TSMC, but we do not own any of the large cap Chinese names. The only marginal exposure we have to China and the Chinese consumer is through our moderate positioning in the luxury goods space, where we have a reduced position in Hermes, which is where China is an important market for them, and which is right now discounting a way slower cadence of growth by the Chinese consumer than has been the case during the last half dozen odd years.
The only thing I would add is, on the internet or large, Chinese large cap side, we're monitoring the incoming data for improvements in fundamentals. I would say what we're seeing on the e-commerce side, so would it be names like Alibaba, PDD, Meituan, we're really not seeing, any dramatic improvement in trends. Competition continues to remain quite aggressive, both locally and also their operations abroad, which is having negative impacts on business fundamentals. Other names like Tencent, which historically was a quite large holding in the fund, but hasn't been owned in several years. Some of the game data becomes very idiosyncratic. So it's just not screening well for us when we look at our data, and we rank all of our both existing holdings and potential securities on a list, and the capital gets deployed accordingly. And none of the larger cap names that historically have been large owned securities by global funds are just not screening attractive to us right now.
Absolutely.
I would end on one note, Will, if I could for a moment, that we remain very encouraged for the opportunity for growth investors, for dynamic growth, and most importantly for folks like ourselves, where we're able to harness the opportunities from disruption, technology, from what we would call the 4Ds, where growth is slow because of demographics and debt, but where there are these discrete pockets of growth in certain technologies and in certain implementations of these disruptive technologies that really provides the opportunity for us to deploy capital and to provide risk-adjusted incremental returns for investors, notwithstanding the outperformance over the last couple of years.
Thank you, Bradley. Thank you, David. And in the interest of time, we need to wrap things up here, but thank you everyone for submitting questions today. And for those we didn't get to, we will follow up with you directly. Our next webinar in the series will be tomorrow at 4:30 p.m. Sydney time, featuring Claire Jarvis and Rachel Montero from Pengana Web Sustainable Impact Fund. And if you haven't already, I'd highly recommend joining us for that one. You can RSVP via our website, pengana.com. And thank you all again for attending, and enjoy the rest of your day. Cheers.